Just a couple of days ago, I told you OPEC has a problem, and it was becoming our problem. Well, after the meeting this morning, it's becoming our problem and Kazakhstan's problem and Iraq's problem. This is getting to be a bit of a mess, guys. Stick with me and I'll walk you through the latest headlines from OPEC, and I'll tell you what they mean this week in oil. Hey, I'm Aaron from the Oil Balance. I'm here to elevate your understanding of the oil markets. Let's go through this chart pack real quick. I think there's a lot of good information in there. If I haven't said it lately, let me remind you, if you just email me or go to our website, theoilbalance.com, I can send you these chart packs if you want. So please go there if you're interested and register, send me free stuff, and I'll get these right out to you. All right, now let's go through this because this is interesting. So OPEC had a meeting this morning, the 3rd of May. We all thought that the meeting was going to be on the 5th, on Monday, but no, they met this morning on Saturday. We got headlines 7 o'clock this morning, my time in Texas, in the central time zone. Basically, what they've done is they said they're going to go ahead and ramp up production between these 8 countries that are 5 OPEC and 3 non-OPEC that are trying to bring production back to the market. But they're going to jump ahead and give us what was originally the October numbers. They're going to give us those in June. So we thought they'd be paced out kind of slowly, about 137,000 barrels per day, increase month on month. No. They keep stepping that up. But here's where it gets interesting. If you look at the data, and there's a lot of data out there, and it's sometimes really difficult to find out which one you want to go with, which one is correct. And here's what I mean by that. So if you were to go to the OPEC website and look at their official data, they give you production numbers based on secondary participants, based on people who are reporting on what the different OPEC nations are doing. These are not firsthand accounts. And the reason they went to that, they also have the firsthand account stuff where each country says this is what we're producing. But they went to secondary sources that would be maybe a little more neutral in the reporting, if that makes sense. So there wasn't any hint of funny business going on when they report these numbers. So at any rate, if you look at these secondary sources for March, and so this is the differential versus these numbers that they have for the month of June. And I know we're kind of bouncing around a little bit here in terms of dates, but it's going to make sense here in a second if you stick with me. So if we were to take the numbers that OPEC published as from secondary sources in their latest market review from March, OPEC, which I've shaded here in the dark orange, and then the other 3, the non-OPEC, the OPEC Plus guys in the lighter orange. OPEC still has 500 a day they could bring back pretty easily. So it doesn't make sense if you look at it that way. Why are the Saudis getting upset? Why are they talking about lower prices for a prolonged time period? That's what they said on Monday when the market crashed. So that doesn't seem to make sense. If you look at someone like Petrologistics, which is my go-to, if you guys are in the industry and you want to track these numbers, again, I think Petrologistics is the best way to go. They're not a sponsor. I wish they were. I've been a long-time user of theirs, and I think their numbers are pretty darn good. At any rate, if you take the numbers from March that Petrologistics was publishing, and it's subscription type data, so I've kind of collapsed it to where I'm not giving away too much information here that from Petrologistics. But the point is that the DOC was way overproducing. Even some of the OPEC countries were overproducing by quite a bit. And so the net difference was about 2 million barrels per day of what Petrologistics thinks happened as far as production versus these numbers here on the left-hand side of the screen that they're going to try to ramp up to in June. Now, you probably saw the headlines, and I've been talking about it quite a bit lately, that April production was actually down versus March for OPEC itself, for OPEC Plus, and specifically for the purposes of this conversation within the 3 DOC countries, the 3 OPEC Plus countries that are participating in this: Kazakhstan, Oman, and Russia. So any way you cut it, if you're looking at the petrologistics data, we're already way ahead. We're already light years ahead of where we should be. If you look at it in that perspective, they've already brought back all of the production that they said they took off over the last 2 years, right? They've already brought that back. So again, if you look at who the main abusers are, again, according to the petrologistics numbers, Iraq is the worst offender, if you will. Kazakhstan's second, UAE's third. So is this mixture of both OPEC and non-OPEC countries. Russia, they're still off by about 200,000 barrels per day or so, but because you're producing it, in north of 9 million barrels per day in a percentage basis, it's only about 2.5%, 3%. So I can kind of see how maybe that gets forgiven a little bit. And for some people, or people are saying there's maybe an OPEC versus or a Russia versus Saudi part of this. I don't think that's it. At least right now, that's not it. At the beginning of these OPEC Plus, there was some strife. Russia trying to get their production down to where they said, to line up with what they committed to with Saudis and the rest of OPEC. I think they're pretty much in line right now. There's always going to be this sort of gray zone where, just like we're doing here in the US, putting condensate and other things into the crude that maybe you can't use domestically, but you can maybe fluff up that barrel of oil a little bit and try to sell it that way. So again, I don't think it's really a Russia versus Saudi thing. It's much more Saudi versus Iraq, Saudi versus Kazakhstan, where these countries are really overproducing. So again, if you look at it, Saudi's actually, it depends, again, whose data you're looking at. They're somewhere around 500,000 barrels per day below this number. And Kuwait is also below this target number from both counts, from OPEC secondary sources and from petrologistics. So those are the two getting the short end of the stick, right? If everyone else is already at or above these sorts of numbers, and Saudi Arabia still has, is still under this number by 500,000 barrels per day, you can see why they're getting upset, why they want to be able to monetize that 500,000 barrels per day, bring it back onto the market. So it's kind of a good news, bad news situation. If they really are producing at these sort of numbers that Petrologistics is seeing, at least up through April, then maybe demand is better globally than we thought. And again, I have some charts on that here in a second. So here, and I've talked about this in the prior OPEC video, but just to bring it back up again, for 2025, of all the big, sort of global headline analytic sources that you can find, OPEC has the biggest demand number of all of them for 2025. IEA has a pretty good one, and then the STIO, which is the U.S. Energy Intelligence Agency, actually has the lowest increase, year-on-year increase for demand. You can see in 2024, OPEC had a really strong demand number. In 2026, they have a really strong demand. Again, these are year-on-year increases, right? So maybe there's something to this, and it would sort of fit with what they're saying here. Even though they're increasing production, so that you're going to see the headlines say production is going up 411,000 barrels per day in the month of June. And in the same breath, OPEC statement literally says, we reaffirm the commitment to market stability on current healthy oil market fundamentals. So yeah, if they are able to squeeze out an extra 2 million barrels per day and the market is grinding lower, but still absorbing those barrels, yeah, maybe that is where they're sort of coming from when they make that statement. The problem is, if you keep adding on to that, if Saudi insists on bringing back 500,000 barrels per day and none of these other guys do anything to sort of pull back any of their production, I mean, this thing can spiral out of control pretty quickly. And I've said over and over again on these videos and then throughout my career, this is the way OPEC deals fall apart. It's when people start cheating, individual countries start cheating, and somebody, usually it's the Saudis, end up with the short end of the stick because they've been compliant. They've been trying to lead by example, by keeping production off the market. So either way you slice it, if the plan is to increase production, the market's going to be oversupplied. And that shouldn't be sort of new news. We kind of knew at the end of 2024, looking at the forecast for 25, the market was going to be oversupplied, assuming some sort of OPEC increase over that time period of 25 and into 26. People had different numbers, but kind of any way you sliced it, it looked like it was oversupplied. But for them to come out now and say, okay, we're actually going to skip forward to the October numbers, we're going to call the October, the rate that we should be by October, we're going to hit that in June already. Are they trying to justify the overproduction that they are giving? Are they telling Saudi Arabia, is Iraq telling Saudi Arabia, look, we're well ahead of this number, 4.1 million barrel per day number that we've agreed to here. But if you make us pull it all the way back to where we were supposed to be in March, we just can't do that. That's too big of a change. So let's fudge it a little bit. Let's increase our production targets a little bit, and at least then our overproduction won't be quite so bad, and maybe we can hit that number better. Maybe that's some of what's going on. Either way, I think on Sunday night when the markets open again, it's going to get hit again. But let's just go through a couple other things here real quick I've got for you. Here's the Q1 numbers. Again, this is from the previous video, but just to put it in context so you can see it again in the context of this, Russia and Saudi producing at pretty much the same levels. Iraq is probably closer. Again, these are from OPEC themselves, the secondary sources. Petrologistics would have them closer to 5 million barrels per day. So we'll see. And again, I think it's not just about the Saudis missing out on, say, 500,000 barrels per day in a falling market. It's also about market share. And I want to really drive that home. As you can see, especially on the NGL side of things, all of OPEC has just been losing market share in the one place where we know demand is growing globally, in the one place that we know people are building infrastructure, particularly China, are building infrastructure to consume NGLs, to make plastics, to make widgets, to make all sorts of things, right? So that's where they're losing market share. China or Asia more generally should be, that's OPEC's backyard, right? They should not be losing market share to the U.S. That's some of their best customers. That's Iran's only customer, literally, is Asia, right? They can't afford to be losing market share there. In terms of just crude oil, because you put crude oil into refinery, again, there's a little bit of condensate gray area in there, but again, they've been losing market share by taking barrels off the market. Well, who's within OPEC? Who's taking barrels off the market? It's Saudi Arabia. Okay, so it seems like Saudi Arabia is finally getting to the point where they're super annoyed and they're not going to take it anymore. And that's how these deals collapse. So I guess it's good that they're meeting this morning. They're having these virtual calls. They're agreeing on where production should be. Unless we see some of these countries like Iraq, Kazakhstan, UAE rein in production by a lot and let Saudi increase their production, get their share of the market back, it's going to be a tough market. I think it's going to be a fairly bearish market. It's good for consumers. It's good for gasoline. It's good for diesel prices. I threw this in here again. This is from the previous OPEC video that I did, but just want to reiterate, when back in 2020, average price for the year for Brent was just over $40. That would put TI in the high 30s. If we do get down there, I'm not saying we will. All I'm saying is if we were to get down into a $30 handle on WTI, you would start seeing people shut in. And what's interesting about that is Bloomberg put out a story this morning. It's a little bit disingenuous, but they went through the earnings reports from some of the big producers, especially the big global integrated type producers. They seem to be okay was still growing production somewhere in the ballpark of 7 to 9%, depending on which exact one you talk to. But sort of the big five, you might think of BP is the only one that's saying no, we're not going to be increasing production. Then you start to look at U.S. shale producers. So EOG was out there. They had a growth target of 3% year on year of production growth, which isn't that's reasonable, right? That's not bad. And because all of this weakness that we've seen in the market so far, because OPEC's trying to bring barrels back, they scaled that back a little bit to an increase of 2%. So the way the article is worded, I'm not quite sure that these companies that they're referencing had time to digest the information from this morning and put out a statement on a Saturday. That seems a little odd. But the point being, the big integrated guys have the system to absorb this sort of thing. So you might be, on one hand, you might be losing on the production side, but your refiners are making up for it, right? Because it's a lower cost, a lower input cost for your system refineries, and you're going to have a good refining margin and be able to sell those into the market. So just from that perspective, if you step back and look at this and say, just at this point, let's sort of play out. Yeah, we're going to have a really bearish summertime for crude oil. Well, that's probably still pretty good for refiners, assuming the jobs market doesn't get hit too badly, which is a bit of a big assumption. But let's just go with that for right now. Gasoline prices will come down, and you'll see demand tick up a little bit, but there's not a huge correlation between falling gasoline prices and demand going up. It's not like a one-for-one sort of thing. Going the other direction, it is very sensitive. If you got gasoline prices outside of California, if you got gasoline prices at like $5 a gallon, you absolutely see demand fall off a cliff. All right, so it's a little bit skewed when prices go down. You don't necessarily see a one-for-one increase in demand on the way down. Yes, demand will be good, but it's not quite the same as when prices go up and demand absolutely falls off a cliff. So the point being, refining margins will probably still be pretty good going through this summer. I have another video that I'll link here talking about inventories in the US where gasoline and distillate still look really tight. So again, it seems to me that refining margins should probably still be pretty good. But the point I want to get to is someone like EOG, who's just a shale producer. I don't want to say just, they're a very good company. They're very good at what they do. But that's the only outlet that they have is crude and natural gas and NGL production, right? And they're already guiding production down. So the smaller, if you just sort of broaden that, EOG is a very well-funded company, very well run, very like top tier sort of production company. If you scale that back a little bit and talk about oil producers, independent oil producers, who go to the banks to get loans, a lot of those loans will require them to hedge. Okay, so that's going to protect them for some period of time, hopefully the balance of 2025, where they've have a pretty high hedge ratio and they're going to go ahead and hedge that stuff. And it doesn't matter too much that the market's falling off a cliff. As I've been saying, if we do get into the mid 50s or below on WTI, you're not going to see any more investment come in. These guys, even though they might be hedged on the production they already have, they're not going to go punch new holes in the ground, right? Because you can't hedge them at $70 on the forward curve or $75 on the forward curve. The weak spot in this market in terms of U.S. producers are going to be the guys who are big enough that the banks can't tell them they have to hedge, but they don't necessarily have that production. Maybe they didn't see that coming. And again, I'm not pointing anyone out. I'm not saying that. All I'm saying is that's what we need to be watching out for over the next couple of weeks, over the next couple of months. In the earnings reports, I think they'll get pretty interesting. I know there's a slew of producers coming up here in the next couple of weeks that could fit in that category. And that's going to be super interesting to watch those investor meetings and see how that goes. So the other thing I wanted to sort of point out, I put this in an earlier video this week too. If you just look at sort of the production, again, U.S. production is so levered to price. right? So as prices increased through 2022 and 23 and 24, production kept rising. It's sort of plateaued a little bit through 24 now, and we haven't obviously seen the impacts of these lower prices that we're seeing now. However, in contrast, Saudi's been taking barrels off the market to try to stabilize the market. So, as they mentioned from the first slide of this presentation, yes, Saudi has actively been trying to stabilize the market. Are they going to be able to keep doing that? Are they getting to the point where they're like, we need to get barrels back on, right? We need to be capturing some of this. So this is going to get really interesting. Finally, I'll leave you with this thought. This is just the open interest and the price chart over past 2 months or so from the CME itself. What I want to point out is as prices started falling again this past 2 weeks or so, open interest really started to kick up. Okay, so as prices really came down, open interest really started to kick up. This would say to me that folks are getting short. Okay, so it would be if there's some sort of bullish surprise to come out, you might catch some of these guys short. But for right now, it seems to me the traders in the market, especially a speculative type trader, is pretty comfortable with a short position. Now we'll see with the COT numbers here coming out. We'll probably do something on that tomorrow. But with the COT numbers coming out, I imagine that would show us sort of a similar thing. So again, this is going to be super interesting to see what happens for the market open on Sunday night, tomorrow night after these statements. It is a little bit unusual. OPEC met on Saturday morning. Again, we thought they would go to meet. They were going to meet on the 5th, which is Monday morning. So again, as far as traders go, hopefully this is getting out there. Hopefully they're checking their emails and being caught up to date. But it could be a really interesting open on Sunday night for the electronic open. So anyway, again, this has been Aaron from the Oil Balance. Please visit theoilbalance.com for more information if you're interested. Thank you for watching. Please subscribe and like this video. Thank you very much. Have a good night.